Oh, family. So I've been doing some research on various banks in Jamaica for my How Do They Make Money series, and also because they've been in the news quite a bit since recently. But with that aside, I also stumbled on some of my UE notes, and I figured that it would be cool for you guys to at least know how the company make billions of dollars while some of us out here, especially me, being Excelsior's unofficial brand ambassador. So if any of that interests you, stick around. Please don't forget to like, share, comment, subscribe, tell a friend. And yo, but that's it. Let's begin. Alright, so all of this begins with your deposit. Yes, they use your money to make money. And they use your money to make money in four main ways. Primarily through lending money to individuals and corporations that is facilitated by fractional reserve. So what is fractional reserve? Fractional reserve essentially allows the banks to use a percentage of the money that you deposited to lend it out to other individuals and corporations. How much percent you may ask? Well, they're only allowed to maintain 6% of the domestic currency and 14% of the international currency. So that's US, Great Britain pound, yeah, so on and so forth. So if it's a bomb and you have 100 in your account, you're only enforced to keep 6%, which is $6. Say, but that don't mean say you don't get your money if you go to the bank and want to withdraw everything. It's just that they'll have to pull it from other customers' accounts or other means of getting back those money. So it can either be from the parent company injecting capital, investments that have paid off, or other persons just paying off their loans or paying a portion of their loans that they borrowed before you came back to collect your own money. And that's why you normally hear people say, if I deposit $1 million today in the bank, later I'm go there for job at $1 million, they can't give it. Which is technically not the whole truth, but there is some truth. But essentially, you don't still have to worry because all of these banks, they have to be insured and they have to have a certain amount of capital on hand. So if in event, which it really occurs, and the banks actually deplete their reserves, the Bank of Jamaica or the central bank of that institution will come in and actually give them the capital needed at a very, very high interest rate, essentially to disincentivize them basically from, always deplete them capital or so on and so forth. So yeah. So essentially fractional reserves allow banks to essentially create money out of thin air while stimulating the economy. So persons who have them savings, another guy might come and borrow $100 million, borrow $100 million and build up different apartment complex, and over the 10-year duration of the loan, the guy has to pay back the $100 million plus, let's say, 15% interest. After the loan is repaid, the banks will be very generous and give you a cut of the profits they made, which is normally less than 1%. Less than 1%. So of that 15% profit they would make, the less than 1% would go to you, and then they would keep the 14+%. They're very thoughtful. So essentially you keep the 0 point whatever there is, and they keep the 14+%. So yeah, and that is the spread. Alright, so see now we explain fractional reserve. Now we can go to explaining how do banks actually use your money to make more money. And the first one is through interest income. And essentially I was just explaining this. Interest income essentially is just the interest they earn from lending money to customers, retailers, and even other institutions. So essentially banks borrow money from the persons that save with them, essentially lend out those money to other persons that want to create productive solutions or stimulate the economy. And then when they collect interest from those money that are repaid, then they give you a portion of it. Not a big portion, but you still get a little something. So in the original example that I gave, essentially they charge 15%, they'll give you one if you're lucky, and then they'll take the 14%. And that's interest income. Second way they make money is through fees. So essentially they make money several ways. So they make money from overdraft, which I've never really understood. Why would you allow me to spend more money than I have and then charge you for spending more money than I have? So there is that. The one that you guys probably are most familiar with is ATM charges. Every time you go use the ATM to withdraw your own money, they charge you for doing that. So there is that. Although you don't have to maintain the ATMs and the AC and all sort of stuff, but yeah. As well as account maintenance fee, low balance fee, they're charging you to be poor. This is not budget the bank. I just find all of these funny. And brokerage fee. Brokerage fee essentially would be fees that whenever you buy stocks and something there, they do generate money from those as well. Because essentially they are the medium on which you guys, access the market through. And while we're on the topic of investment, the third way to make money is through investment banking. Alright, so essentially what investment banking is to facilitate big money transfers or big transfers as well. So typically when it comes to IPOs, APOs, normally see companies have like an estimated or a dedicated amount of money that will go towards paying fees whenever they're coming to the market. Banks benefit from those as well. So IPO, APO, right issue, any intermediary thing that will connect companies to regular day consumers. Yeah. They also make money through the fees, as I was mentioning. They make money from you accessing the market as a broker. They also make money through like wealth management. Like you don't want to invest your money, so they'll have professionals that will invest your money for you essentially. So like mutual funds, index funds, they normally have their own funds that have specific categories. It can be real estate or growth stocks or dividend stocks or and the fourth, but probably not the last, but just one of the fourth biggest ones is actual like payments. And when I say payment system, is that essentially banks are really the center of all financial or most financial transactions that happen on a day-to-day basis, because companies pay bills and other obligations through the banks. People normally get their pays from banks, your card or your bank account. So there is that. Also, whenever you're doing acquisitions for real estate, stocks, those are processed, and they're charged. You are charged for it. And probably what you guys can more like relate to is like online payment processes. So whenever you go to Amazon or Shein or Apple Pay Music, I guess who pay for music. Anyways, yeah. So essentially they are the financial intermediary that connect people with people, people with business, business to business, and so on and so forth. And saying all this now, I know you might feel some type of like, why do I charge you so much money? And thieving this company, but essentially to run a successful bank is not easy. There's checks and balances that you have to maintain, there's regulations, one of which is the biggest is the capital that you're going to need to actually do it. Essentially when I was doing regulatory or financial institutions, it was 250 million Jamaican dollars for a bank or commercial bank, merchant bank. But when I went on BOJ, it said a million. So 150 million or 156, give or take, US dollars to my bank. So there is that. You also have to follow the KYC protocols, which is know your customer. So I'm of interest in a scammer, them a money launder the money. You have AML, which is anti-money laundering, them have to maintain. And essentially it's a bag of stuff because BOJ regulation is long, very long. So yeah, it's a lot. So even and then the thing is there is just a few when you think about it, it's a few because they are always monitored. And you also have interest, you maintain customers and employees, and the employees don't feel like them can borrow money out of them clients account. And yeah, it's a lot for a financial institution. So there is that. So whenever they do run it successfully, they do generate enough capital to ensure that your money is safe and they can make a profit. So yeah, and sometimes you have to maintain ethics and all sort of stuff. So it's a lot. So yeah, and fun fact, the reason why like you might have to say get 1% interest rate and them some there it's kind of good because back in other days, them normally charge some 30 and 40% for borrow money so that you could get a 20% or so on your account. And that's, I guess, where the notion was you're always saving money, you get money from it. But that's not the case because even though the spread might be the same, they'll just drop the interest rate. So you essentially get nothing, but also get to borrow money at a relatively cheaper price than they would normally say. And yeah, I'm gonna be your shot. This is me explaining, but yeah, thank you guys for watching. Hope you enjoyed. Don't forget to like, share, comment, subscribe, tell a friend, and catch you in the next video. As always, love you guys. Peace.